Right, so we could talk about the market timing model, right? And we're gonna be based on so it's a model, the middle one we talk about. Okay. So this is the middle one we talk about, then we talk about the third one later on. So market timing. So what's the idea? So the basic question is, so we're gonna basic assumption. So as a basic assumption in this model, we're gonna assume investors have settlement as in the last 2 weeks. So in fact, investors have fluctuations in valuation, right? There are fluctuations in valuations that has nothing to do with fundamental value. Right, so this is something we assumed is to be the case. Investors have fluctuations in valuations that have nothing to do with fundamental value. And in this case, the question is, when do you want to use stock merger versus cash mergers? So that's the question. And if you think about this question based on the assumption, then it's actually we can see the model, the idea of the model is actually very simple, right? Given that the investors have settlement, so valuation of firms fluctuates and the fluctuations has nothing to do with fundamental value. We just assume the fundamental value is going to be fixed, right? For simplicity. So we're going to assume the fundamental is going to be fixed. There are fluctuations in valuations. In fact, let me draw it. Just for the sake of our illustration. Well, wait a minute. Why don't I draw it here? Why don't I draw it here? Okay. Right. Just for the sake of argument, let's say the fundamental value is just flat, right? Just to make it easy to see. And then you have fluctuations in value. When do you want to use cash mergers and when do you want to use stock mergers? If that's what happens that's what happens. What do you as the management of a company, when is it a good idea to use when is it a good idea to use stock to acquire someone else? When the stock price is high. That's right. When the stock price is high. So in this model, what you want to do is use stock when your company's value is relatively high. When you think your company's value, when the market is valuating your company with very high value, with very high ratios, then that's when you want to use stock. And if you think the market is undervaluing a company, then you use cash. Right? That's the fundamental idea of the model. That's the idea of the model. And you can see that given this behavior, cash mergers always lose money, right? Because cash mergers happens in this area, then the stock price has to go back down, and then stock mergers make money because they go back up, right? If there is fluctuation in stock price, and stock mergers only happen when stock prices are abnormally high, or well, to be more accurate, when valuations are particularly high, right? Then you can it's just natural that you basically always lose money on stock mergers, because stock mergers do not happen on random. Stock mergers happen precisely at the moment when valuations are high, right? So that's why they are money losing. And cash mergers do not happen by random. Cash mergers happen when valuations are low, so they make money. So all the intuition is here. What we're going to do next is just to lay it out in a little bit of mathematics. One thing that is a step further is to think about, well, now that you've learned that stock mergers happens during high valuation, it seems like you would be someone who votes companies that merge with stocks, right? Now, I've told you that stock mergers are a bad idea. Like stock mergers usually only happen when valuations are high, and so that's why afterwards you usually get poor return. You usually get poor return. So why won't people avoid companies that announce they use stock mergers? In some sense, they do, because when companies announce that they're going to merge with another company, very often their stock price goes down, telling you that people are selling. It's just that the rational behavior of avoiding companies doing stock mergers are not enough to overcome the market or the general market sentiment. So there are rational response. People do know that stock mergers, there are investors who know that stock mergers generally destroy value rather than bring value, and they sell, which is why company stock price typically go down. But they do not go down enough to eliminate everything. It still happens, right? So now the model. It's actually not a complicated model. It's quite simple. Right. So in this model, there is a short run and a long run, right? So first, we're going to have a fundamental value, right? We have some fundamental value, and how do we do that? We're going to basically assume that the value is tied to the capital. So I guess I shouldn't say fundamental value. I'll just say some sort of yeah, I'll just let me just not call it fundamental value because in a short run and long run. So let me just say, okay, so the company has capital, right? Just say capital, right? And you have the acquirer and the target. And acquirer at capital KA, target is capital KT. So in that case, combined it would be KA plus KT. So capital is something just kind of measure what they have. In the short run, the valuation is multiple. Is a multiple multiplied by the capital. SA times KA, ST times KT, and combined it would be some sort of a combined valuation S times combined capital. In the long run, it is assumed that there is, in fact, no particular synergy. So if state unmerged, then the acquirer would have GK, would be worth GKA, the target would be worth GKT, combined firm would be worth GKT plus KA. So there is no synergy, but that is not actually very important. So it's assuming that there is no synergy just for sake of simplicity and to demonstrate the point of market timing. It doesn't actually change the result if you add a synergy. It still works, right? Synergy brings more incentive to merge, right? But what we see here is that just by market timing, you would have incentive to merge with stock. So the assumption is there's no synergy in the long run. All right. Okay. Now, the key is, well, based on the difference between S and G, what would happen? So we have two methods of acquisition, right? Cash or stock. Oh. And we'll start with cash. Okay. So cash, we just say in cash, acquirer pays P per unit of capital. All right. So this is the valuation. So the acquirer pays a certain price per unit of capital. P has to be at least as big as ST, otherwise it won't work. And what would happen in this case? What would happen in this case? How would the market value change when the acquisition is announced? Okay, so there's a how to spell announce? Is that just spelled correctly? ANNOUNCE OUNCEMENT. So announcement effect. What happens when the companies announce that, okay, so the company A is going to acquire company T? What would happen to them when the market? So the market basically respond to the change in value, right? What would happen to the acquirer? What would happen to the value of the acquirer? Acquirer used to worth acquirer used to worth SA times KA, right? So this is the original value of acquirer. Now, after the announcement, we just assume that discount rate is negligible, right? So just for simplicity. So after the announcement, the investors say, well, the acquirer is going to buy the target company. So combined that this is what they are worth. The target is going to receive P per unit of capital multiplied by the unit of capital, or you can take them as shares if you want. I don't think it really changed the interpretation here. So that's the change. Combined value, price paid for acquisition, price paid to target. Right, so it's very simple, right? It's just, all right, you're gonna merge with another company. What is the combined value minus the price paid minus your current value is the change in market value. Right, this is the change in market value of the acquirer. And for the target, it's very simple. That's how much the target is worth, KT. After the announcement, you know that the shares of the target is worth PKT. So that's the change in the value of the target once the acquisition is announced. Now, typically what happens is the price paid per share is going to be higher than the market price per share of the target. So immediately the value of the target would rise by that amount. So this is what you do see in actual mergers. The value of the target would go up immediately to the by the difference of the premium, by the premium, because otherwise it's just like a no-brainer arbitrage, right? One share is going to be worth P in the future. It's only selling for ST right now. So why not buy one and just wait to gain the premium? So that does happen, right? So we can take a break. Right, so Okay, so the target's market value goes up by essentially the premium. Okay, so okay, and now for the target, is as I said, it's quite obvious that as long as there's a premium over the current market value of the target, then you would have that. Then the target's value, the target would have a positive market response. For the acquirer, on the other hand, it depends on whether, but that depends on the relationship between SP and SA. Now, if S is big enough, then you would have a positive response. But if S is not big enough, then you have a negative response. Long run. So this is short. So this is short run. Long run. Long run. As I mentioned, in this model, we assume there is no synergy, but even if there's synergy, it doesn't really change the result of the model. It will be the same. In the long run, if you think about the long run, the acquirer's value is just QKA over plus KT, right? In total, right? That's the value of the company. That's the value of the company. Now, if you consider the gains and losses, then you subtract back what they pay. Minus the opportunity cost, right? Minus what the acquirer would have value anyway. So in total, that gives you a gain loss of Q minus P times KT. So that's the gain loss in the long run versus the short run. The target, on the other hand, receive P. They would have worth QKT in the long run. So in total, you have P minus QKT. And immediately, you should notice that this is in fact a zero-sum game. The sum is 0. So this model is set up in a way that is a zero-sum game because there is no synergy. So if I pay you more, that means I am making a loss. So to conclude, in this model, long run gain loss depends on whether P bigger or smaller than Q, right? So if P is bigger than Q, then the acquirer loses out. If P is and the target gains, if P is more than Q, then acquirer gains and target loses. So that's how that's in the long run. All right. Now stock number 2, stock. So now this is cash. Now we're going to go to stock. The way stock works is we're just going to assume that we're going to express it in terms of the acquirer paying a part of its own value. So it pays a fraction x of its own value to target shareholders, right? How much does it have to be? How much does it have to be? For the same valuation, P per capital of target. So we assume that you want to make the payment the same as before. It's just that you're trying to use a fraction of its own value. Then it's going to be x equals to P times KT. That's the payment you need to make over. Now, this is going to be the value we're going to use as the base is going to be the combined value in the future, right? So what the company is going to be worth at the moment after the announcement of the deal, not before, right? So this is going to be so as you expect the stock price to change, so you're going to use the stock price after announcement as in order to calculate the fraction that you want to pay. Does this make a difference then in the short run? So we base the calculation on the same valuation P per capital, and we calculate the fraction of the value of the acquirer that needs to be paid. And if you think about it, it doesn't matter. After all, in the end, we try to pay PKT, so it doesn't actually make a difference. And you can quite easily show that it makes no difference at all, right? So the announcement effect is the acquirer is worth 1 minus x s times KA plus KT minus SA KA. Now there's no cash payment, but rather a payment in terms of a fraction of the value. The target, on the other hand, receive that amount. So x times s times KA plus KT minus, they have given up their company, so minus STKT, right? So the acquirer pays a fraction of the company to target shareholders. And if you simplify, then you can see, if you simplify, you expand and then simplify, it's quite clear that you just get back what you have before, which is expected. That's what we're trying to achieve. The payment in the end is the same. Right? So this is PKT minus SAKA. So in the end, it seems like someone is remote controlling the system and telling us we should end the class here. What happened? Okay, so let me. Right. same. So here, same as cash method. Short run. So short run doesn't matter. So compensation to target shareholders is calculated based on short run valuation, so doesn't matter which one you use. Cash or stock doesn't make a difference. Right, so now long run is going to be different. Long run. Arrow should be here. Okay. In the long run, because the valuation is different, so you can't actually cancel out terms like that directly. So let's see. Okay. So long run. In the long run, for acquirer, the value is 1 minus x because they paid part of the company away, times QA plus KT minus what they would have gotten without acquisition. This is the part where you would have to do a bit of simplification. So you can one thing you can do is so you should just multiply everything out. It works. So you have 1 minus PKT SKA plus KT multiplied by QKA plus KT minus QKA, and you can see what you can cancel out. The first term, there's nothing you can do. You just have to multiply QKA plus KT. The second term, the KA plus KT cancels out. You're left with minus PQS KT, right? Minus QKA. QKA cancels out from the first term and the last term, so you are left with QKT minus P over S QKT. And finally, by grouping the terms, you are left with 1 minus P over S QKT, right? This is the acquirer's value in the long run. The acquirer's shareholders gain in the long run. If the target's gain is they get X of the new company as compensation minus QKT, which is what they would have gotten if they didn't sell their company. Once again, you can expand it. You can expand if you want. So PKT SKA plus KT times QKA plus KT minus QKT. And if you simplify it, I'm just going to skip the step here. You're going to get PS minus 1 times close bracket QKT. Once again, it's a zero-sum game. Because there is no synergy. But this is not the point. The zero-sum game is not the point. We just assume there's no synergy for simplicity. If you have synergy, it would be different. The key is what we want to do is we want to see we want to see that we want to compare the gain under stock compared to gain under cash. So one is in stock is for the acquirer is 1 minus PS QKT. Under cash is Q minus PKT. Right? So let's compare that. So for acquirer, who is the one to offer the method of purchase, the method of acquisition, they're comparing cash versus stock, which would be Q minus P KT versus Q minus P, versus 1 minus P over S QKT, right? And to make it more comparable, let's multiply the Q back inside. Yeah, would that be easier? Yeah, I guess it would be. Let's see. So then would be Q minus P times Q over S KT, right? So now comparing Q minus P times K bracket times KT versus Q minus P Q over S close bracket times KT, what can you say? What can you say? Which one is better for the acquirer? So the term, so Q over S. So Q over S term here is scaling up or down P, right? And P is the price paid. The smaller the price paid, the better. And how do you get a smaller price paid in the case of stock? Well, if the bigger S is, the better, because that makes the cost lower. So stock is better if Q over S is bigger than 1. No, sorry, smaller than 1. Smaller than 1. Right? You want to lower the cost. Smaller than 1. Right? Stock is better if Q over S is more than 1. So that means S is bigger than Q. So that's the conclusion of this model. As an acquirer, when do you want to use stock merger? You want to use stock merger when short-term evaluation is high. When short-run valuation relative to long run. So that's what the model wants to say. Use stock when short run valuation is high relative to long run. As I said, this is simply the logic of the diagram we drew just now. This is just, as I said, this is just everything in this math can be expressed in this diagram. That's what the model says. Stock mergers. Use stock mergers when the short run value is higher than the long run value. That's it. That's what the model says. Economics very often is just using a bunch of mathematics to express what is pretty intuitive, right? Yeah. Okay. One thing that you do note is that this says nothing about the long run prospect of growth, right? The fundamental value, I drew it as a horizontal line for just for simplicity, but you can see that this will still work. Even if fundamental value is going down, right? It doesn't matter. Even if fundamental value is going down, in fact, fundamental value going down is probably even better. This doesn't change the right. It's still you still have all these opportunities to merge, right? So in the long run, it's a pretty bad place to be in business, but in fact, you think about it, it's pretty good if you sell here, because that gives you even higher difference between the short run and the long run. So for this to happen, you need some sort of dispersion, right? Now, what wouldn't work, what wouldn't be very good for stock mergers is if you have no fluctuations. Wait, why am I writing all these on the board? Okay, I'm gonna give up here. Go back here. Sorry, I forgot about this part. Okay. So okay. So once again, as I said, all these can be summarized in the diagram, where when you have fluctuations, you want to use stock. I think I used a red color just now. You want to use stock right? Use stock mergers, right? And of course, the model still applies even if fundamental value is going down. Because as long as you have fluctuations, then you still have all these opportunities to use stock mergers. So it still works. What doesn't really work for stock mergers is that if you have no fluctuations. If you have no fluctuations like that, right? Then there is no particular benefit in using stock. There's not much to gain from that. So when valuations are relatively stable, then there's not much incentive to use stock. So valuation stable. No incentive to use stock mergers. Okay. Now, finally, a few things that you want to note that's not about the theoretical aspect of the model is if you believe in this model, that stock mergers happen, stock mergers happens when valuation is higher than the fundamental value. what can you conclude when you see that there are a lot of stock mergers happening at the same time? So now that you see a lot of, so let's say you see stock mergers in airlines, you see stock mergers in IT, you see stock mergers in even utilities or something, right? They all use stock mergers at about the same time. What can you say about the market? Given that the model says that stock mergers are more likely when valuations are higher than the long run, higher than long run, that means if you see different industries you see stock mergers in different industries, that means that the valuations in different industries are correlated, right? Or I should say the overvaluation is correlated, right? So in some sense, once again, that goes back to the investor sentiment story. How come the valuations are particularly high at the same time in different industries? You can't explain it by random chance, right? It has to be some sort of correlation between them. So one explanation would be investor sentiment. Investors are particularly optimistic about the market in general, so they place a high value on all the industries. And as a result, all the industries are more likely to use stock mergers. And another issue that you have to consider. Now, as an empirical strategy, as I said, as a rational investor, knowing that stock mergers typically give you bad returns. This gives you one way of figuring out whether the market is overvalued or not. It's not necessarily easy to figure out whether a market is overvaluing or is like in a hype or not, right? Whenever the market is in fact in a hype, you still see very diverse opinion on whether the valuation is justified or not. Right before the market crash, there will still be a lot of people telling you that it's completely justifiable that the market is so high. That happens every single time, right? Remember, if you're for those in Hong Kong, when Hong Kong stock market was at 28,000, like when Hang Seng Index was at 28,000. Plenty of people say that Hang Seng Index is going to go through 30,000 or even 40,000, right? But then it crashed. It's not easy to see whether the market is overvalued or not. However, in this model, one way you can tell is, well, are companies using stock mergers? Because companies use stock mergers only when they believe the market is placing a very high value over to their true value. That's one way that you can utilize their information. Use the behavior of the management to figure out whether the companies themselves think their valuation is high or not, right? For companies like Apple, they never use stock, so they never think themselves up as being overvalued. They always use cash. And if you're an investor of Apple, that seems pretty justified. So, and it's the same for Google. Never use stock, always use cash. So that's one way you can figure out whether it's overvalued or not. All right, so we're probably gonna stop here. We have to stop here. So next week we're gonna go over the last part of this course, which is overconfidence, and that will be done.